In the second quarter of 2020, equity markets largely recouped much of the steep losses experienced in the first 3 months of the year. The S&P 500 rose over 20% to bring the year-to-date losses to just over 3%. International markets rose in the second quarter as well, although both developed and emerging international stocks finished the quarter down over 10% year-to-date. Small cap stocks recouped about half of the first quarter's losses. However, they still finished the quarter down more than 15%. Bonds performed well as investors continued to seek out safe haven investments. This bar chart shows total return by sector, with second quarter returns in light blue and year-to-date in dark blue. Technology stocks were one of the best performers in the second quarter, continuing their outperformance from the first quarter and bringing their year-to-date total return to just under 15%. Consumer discretionary stocks, led by Amazon, also saw good performance as a group. Although energy stocks rose over 30% in the second quarter, the increase was not enough to offset the negative impact from the first quarter, with the sector down over 35% year-to-date. Financial companies, such as banks, also underperformed, as low interest rates and the expected losses from loan defaults continued to weigh on results. This chart illustrates the remarkable market recovery that occurred in the second quarter. From a peak on February 19th, the S&P 500 fell 33% by March 23rd. Then, as fiscal and monetary stimulus measures were put into place and positive developments in COVID-19 vaccine and treatment options began to emerge, the market rose nearly 39% between March 23rd and June 30th. Although the stock market just about recovered from the losses of the first quarter, the economic damage to earnings is in the early stages. This bar chart shows the overall year-over-year growth in earnings per share of the S&P 500, as well as the breakdown of what contributed to that growth: margins, revenue, and share count. First quarter earnings growth fell 49% year-over-year, primarily due to margins falling substantially. Many companies faced significant losses due to lockdowns and mounting costs as the coronavirus pandemic took hold, likely leading the U.S. into recession. As stocks have risen higher while earnings have declined, valuations have become elevated. This chart shows the trailing 12-month price to earnings, or PE, ratio of the S&P 500 over the last 15 years. This is the ratio of the index price divided by the last 12 months' earnings per share value. The S&P 500 PE ratio finished the quarter at over 22 times, the highest level in nearly 3 years. This high valuation gives us reason to be cautious, as current levels look a bit stretched compared to past years. This chart shows the U.S. money supply in blue and the velocity of money in orange. The velocity of money measures the rate at which money is exchanged in the economy. The stimulus measures that are credited for driving stock prices higher have also created a spike in the supply of money. The U.S. money supply went from about $15.5 trillion to $18.4 trillion between March and June of this year. At the same time, the velocity of money turned sharply lower. In other words, there's a lot of money in the banks, but no one is spending it. Personal savings rate data also indicates that most Americans are saving their money rather than spending it. This chart shows the U.S. personal savings rate as a percentage of disposable income. This rate went from around 7% before the pandemic to over 30% in April. The $1,200 stimulus checks sent from the government appear to have been stashed away in savings accounts in order to prepare for troubled times ahead. As shelter-in-place orders went into effect around the country, many stores halted their operations. This chart shows the U.S. retail sales growth on a year-over-year basis. This value excludes food and services and represents a majority of discretionary consumer spending. Retail sales numbers fell precipitously, down over 15% in April, before recovering somewhat in May. The drop in these sales numbers has hit retail consumer businesses particularly hard, with several well-known retailers filing for bankruptcy in the wake of this pandemic. The chart on the left shows the 7-day moving average of new COVID cases, and the chart on the right shows the 7-day moving average of daily fatalities from COVID for various regions. Severe lockdowns in Europe and China helped bring the daily increase in new cases and fatalities lower, although North and South America have subsequently seen a surge in new cases. This resurgence threatens the reopening of businesses, which could jeopardize the nascent economic recovery. Most traditional economic data is gathered and released on a monthly or quarterly basis. However, other sources, such as OpenTable reservation data and Apple Maps usage, help provide insight into trends on a more frequent basis. This chart shows year-over-year mortgage, dining, travel, and hotel activity data since the middle of February. While purchase mortgage applications and driving direction usage have recovered to positive year-over-year growth after an initial decline at the end of March, other indicators remain far below normal levels. Total global flights, hotel occupancy, seated diners, and TSA traveler traffic are all 40 to 80% below levels seen a year ago. This chart shows the performance of the market cap weighted S&P 500 index compared to the performance of the equal weighted S&P 500. Both indices have exactly the same 500 companies included, but the traditional S&P 500, as seen in purple, weights each stock according to market cap, while the equal weight S&P 500, as seen in orange, weights every stock equally. The equal weighted version has underperformed the market cap weight index, since many of the best performing stocks this year have been the large mega cap companies such as Apple, Amazon, Facebook, and Microsoft. This chart shows the U.S. inflation rate over the last 10 years. With consumers stuck at home, mostly saving instead of spending, there are fewer dollars chasing the same amount of goods. This has created downward pricing pressure, which has brought inflation from almost 2.5% at the beginning of 2020 to near 0%. As the world went into lockdown in the first quarter, travel and almost all other economic activity came to a halt, leading to a decline in the price of oil. This chart shows the spot price of Brent crude oil. This decline was exacerbated by a price war between Saudi Arabia and Russia, as both countries refused to cut production, which led to a further oversupply. After both countries came to an agreement and lockdowns began to lift, the price of oil rebounded, but it is still below pre-pandemic levels. This chart shows job openings in dark blue, hires in dark gray, and layoffs and discharges in light blue, with the gray shaded areas indicating recessions. Before the pandemic, the U.S. had been experiencing one of the strongest labor markets of the last 50 years, with rising job openings and minimal layoffs. This came to an abrupt halt as lockdowns caused hires and job openings to decline and layoffs to spike at a level far greater than the Great Recession. Job openings, for example, went from 5% of total employment to under 4%. This chart shows the total assets held on the Federal Reserve's balance sheet going back to 2007. For years, the balance sheet was maintained around $900 billion. In response to the financial crisis in 2008, the Fed instituted 3 quantitative easing, or QE, programs, which injected cash into the markets through asset purchases. These QE programs brought the balance sheet total to about $4.5 trillion. At the end of 2017, with a strong U.S. economy, the Fed began to unwind this stimulus by letting the securities mature and not reinvesting the proceeds. However, in response to the coronavirus pandemic crisis, the Fed stepped in to buy U.S. Treasuries, commercial paper, and other assets in order to maintain market liquidity and stability. In a matter of weeks, the Fed balance sheet increased drastically to over $7 trillion. The massive fiscal and monetary stimulus plans from the U.S. government and the Federal Reserve have driven the equity market recovery. Despite falling earnings, stocks are near all-time highs, resulting in stretched valuations. Inflation has fallen to near 0%, but interest rates have as well, decreasing yields on fixed income. The economic data and equity market levels appear to be telling two different stories. At some point, they must relink, whether it be a swift economic recovery or a market decline. Because of this uncertainty, we believe now is the time for caution.